Okay, we're moving pretty quickly through everything here. I hope everybody is understanding all this material and looking at the test scores. It looks like everybody is really coming along good in this course. Chapter 10, 11, and 12 start getting into in a little bit more detail the particular types of loans that a real estate consumer might want to look at before making an offer on a piece of property. Chapter 10 starts us out with conventional financing, and conventional financing is the way a lot of people choose to buy. There are some different types of conventional loans. Looking at page 314, you have conforming and non-conforming loans, and what we deal with primarily are conforming loans. And it's like we talked about earlier in the course. It doesn't make a whole lot of difference whether you're buying a home in Abilene, Texas, or whether you're buying one in Jackson, Mississippi. The conforming loans are basically, the underwriting criteria are basically the same. And basically what a conforming loan is it means it is packaged and underwritten to be sold on the secondary mortgage market. So when your customer goes into the mortgage company, that loan, once it's closed, is going to be sold. There are several big purchasers of secondary market mortgages. Wells Fargo is a big one. Chase is a big one. Bank of America. And there's a few more of the bigger banks that buy these mortgage loans. And the reason they have saleability or marketability is that the mortgage company or the loan originator and the underwriter has assessed the risk for this file. It's gone through automated underwriting. The risk has been assessed and has been determined. Your customer has been determined to be a good credit risk. So basically, most of the work is out of the way in that regard. Then they're sold on the secondary market, and then the big lenders, the big buyers of these secondary market loans, then conduct all the servicing. And what that means is they collect the payments, they maintain the escrow accounts for taxes and insurance. They make sure the tax bill is paid at the end of the year. They make sure the insurance is always in force. So that's another role of the big banks. On the bottom, page 314, there are characteristics of conventional loans. Y'all can read through that. That's important. Page 315, it talks about loan amounts, what the loan limits are. There are loan limits on these conventional type loans, how they're amortized, the loan to value ratios, and so forth. On page 318 and 19, it talks about risk-based loan fees and private mortgage insurance. And private mortgage insurance basically protects the lender against the buyer's default. So your buyer is paying a premium at closing when their loan-to-value ratio is above 80%. So if you have a customer that's putting 20% down, that customer is not going to have to pay private mortgage insurance, because with that much money into the property, the lender determines that the risk level goes down because of the amount of money they're putting into the property of their own money. The risk level goes down, therefore private mortgage insurance is not required. Any loan-to-value ratio above 80%, they're going to require that customer to pay for private mortgage insurance. FHA, it's called mortgage insurance premium. On a VA loan, it's called the VA funding fee. Y'all can kind of read through chapter 322, 23, 323. I wanted to kind of touch on, I know it's in the chapter, touch on kind of some of the rules about owner occupancy on all these different mortgage loans. Conventional is no different. To get the lower down payment, longer term, lower interest rate conventional loans, the buyer must agree to occupy the property as their principal residence. So your investor type loans, people that are buying rentals, maybe a duplex or something like that, and they're going to basically rent the property out, use it as an investment property, those loans are going to require a higher down payment, maybe a little bit higher interest rate, possibly a little shorter loan term, but simply because of the risk factor. The lender is assessing risk when they're making these mortgages, and be sure and keep that in mind. Chapter 10 also talks about buy downs, mortgage buy downs. Y'all can kind of read through that. Balloon loans, loans with balloons on them. And then kind of the outline of the chapter, and be sure and take your chapter quiz, kind of look over those questions, and then we'll be back with chapter 11. Thanks.